a little changed after a week or more of continuous declines. Another big decline yesterday as the sort of market shifts from a slightly glass half full to glass half empty sentiment. Let's kick off with Kevin Wright, lead analyst at APAC and for Kpler, sitting in Singapore. Kevin, markets are down 15% since sort of popping its head above $70 a barrel. Where do you think the biggest drivers are at the moment?
Good morning, Sean. Nice to be back on the webinar. I think we've got a very interesting scenario on crude right now. Ignoring the fact that we've got a Suez Canal blockage today, which I think is going to be very short-lived, we've seen effectively a pullback on crude in the last week and a half, as you say, 15% and another $3 or so yesterday. I think what's happened here is, the oversupply is still weighing on the market, and I think we're seeing some fund money pulling out. I think there's a lack of belief that demand is returning on the product side, and as a result, some of the hedge funds that have piled into crude in the last couple of years, or in the last year or so, have pulled back and pulled out, and therefore we're starting to see some of that weakness. So I think this is really profit taking from where we've risen from over the last year or so, and the ongoing sort of oversupply situation.
Ole Hansen, head of commodity strategy, Saxo Bank, sitting in Copenhagen, the other side of the Suez Canal to Kevin. I'm not sure I'd share his optimism that boat looks pretty wedged in, but nonetheless, the market did yesterday, Ole, move into a contango structure for the first time in a while. What's your reading of the direction of travel?
Well, we've seen two slapdowns now within the last week, and absolutely in the same line as what Kevin just said. It is a market that's probably got too overexcited in terms of the short to medium term outlook for the recovery in global demand. We're seeing this virus just continues to be very sticky, even in the UK where they're approaching 50%. They're still very worried about a third wave. So it just indicates that the demand growth that has been priced in for 2021 is continue to be backloaded into the second half of the year, and it basically means we need to see a quite aggressive recovery for those numbers really to stack up, and on top of that, I think we cannot avoid saying the reduced risk appetite coming from the rising yields that we've seen in the US since the beginning of January. It does have a negative impact on speculators and then on levels of investments, and we've seen that in the oil market. Even though the price will continue to move up, especially after the latest OPEC Plus meeting where they did the rollover, we actually haven't seen any additional new buying into from speculators and from hedge funds in oil for the past 5 weeks. An indication to me that they were starting to become more risk adverse. So we are seeing a market that's just adjusting to current fundamentals, and again we are once again just facing a market where we just simply don't know how quickly we're going to get back to we're going to get mobility back. Just look at the airline index. They had a massive drop over the past few days. So all the excitement about everyone going traveling this summer has been dented. So that's where we are. OPEC can keep supplies down, but really what counts at the end of the day is demand, and that's then still not recovering strongly enough.
In some ways, that ship wedged into the Suez Canal is a bit of a metaphor for the recovery of the world economy, which was looking rather positive. But Henry Wang, president and CEO of Gate International, sitting in Hong Kong next to the world's biggest oil market, or certainly become one, importing world oil market, and the US the other. Both those markets remain the sort of optimistic centers of the world recovery, Henry. But in China, that recovery has slowed down a bit. Their purchasing of oil seems to have stepped back a little bit.
Yes, thank you, Sean. That's a very important point that you have brought up. I think China has grown in the many years, last 20 years, working in the China market in Beijing as a director of Shell and then director of some of the companies. You've certainly seen the growth of the market on a very, very fast basis. But now I think at this stage in time, the growth of the oil market is now in a more conservative way, I think, in the sense and looking ahead, with President Xi Jinping's speech in the UN declaring the new target for China to reach net zero by 2060. And we can see that a lot of the Chinese state oil company and national oil companies are now planning slower growth in the fossil area, but at the same time diversifying into the clean energy area. So it's a very, very interesting picture. And I think this also, the lower buying and the shift in corporate strategy by the big oil company in China is adding to the uncertainty of the market that has been brought up by very, very well by my two other speakers and yourself.
Kevin, just to come back to the news of the day, the blockage of the Suez Canal is now about 24 hours. I was surprising to read actually that this first happened early morning Tuesday rather than early morning Wednesday. But it's 24 hours locked in there. The ships are backing up. The oil markets seem unperturbed.
Yeah, and actually, just while we were sort of talking about the impact of that, I had a quick look at our own platform. As you know, Kepler, there's an awful lot of tracking of commodities.
I can see them right behind you. The ships clogging up.
Exactly. That's not a live picture. That's just my virtual background. But thanks. But I was
You'll need to update it.
Absolutely. I should get it live and we could actually see them.
Exactly. That would be fun.
Containers, I'll tell you. But I was, just to the point, I was just looking at our platform to see what the congestion picture is looking like in real time. And obviously at the southern end, we've got 1, 2, 3, maybe a dozen or 15 or so ships loaded, waiting to go through, waiting to transit the canal. And we've got obviously a lot of ballasting ships and also loaded ships on the north side of the canal as well. So the impact is starting to grow. And, I sort of joked a moment ago that it would be short-lived, but maybe it's going to be a little bit more complicated than we expect. I mean, it's a 400-meter long vessel. It's 59 meters wide. It's 200,000 tons. It is not a small thing. And if it has got wedged into the walls effectively of the canal, then that is going to be quite a significant logistical exercise. Now, even if it doesn't take a long time, as we all know, the volume of traffic that goes through the canal is so high that even a short-lived couple or 3 days of impact will significantly affect supply chains effectively, and will also affect the diesel moves to Europe, the gasoline moves, and obviously naphtha moves from Europe to Asia. So it could have a bit of an impact, I think, actually.
Ola, your thoughts on that? I mean, pre-COVID, there was about 2.5 million barrels of crude oil moving through the canal each day, and about 2.5 million moving of products. But that includes the Sumed pipeline, which is a sort of an escape valve from the congestion of the canal. So you got the pipeline and the canal. That's 2.5 million each day for crude and products, but includes the pipeline and the canal. So there is a bit of an escape from this congestion if needed.
There is, but it's obviously something that when we see such a major supply line clog up, it will have an impact. But as Kevin also said, even though it looks like it could be not hours, but maybe a couple of days, it is still a temporary thing, just like we saw in Texas just recently with the freeze there. So in terms of dislocating the global market, probably not going to be long enough for that really to happen, but it will create some local distortions, which obviously will take some time to even out again.
Well, we have OPEC Plus meeting in a week's time. Given all of the backdrop of what's happened in the markets in the last week or so since we touched $70, what do you think is the decision that faces OPEC Plus?
Well, I think they were most certainly looking forward to a meeting where they were going to increase production and looking at some prices which were in the high 60s. Now suddenly we are facing the low 60s and just kissed that level almost yesterday, and that so they obviously will now have to look into what kind of demand are they seeing, and we could see last month that the fact that they did a rollover was because of not because of April shipments, but for May that they could already see that there wasn't enough demand to justify the increase in production. So now they're coming into the April meeting, which is probably more likely the summer months, where we are expecting a pickup just generally from the pickup in driving activity. So it will give us a very, very strong signal about what kind of demand they are seeing coming in for their crude oil into the summer months. At this point in time, the market probably needs some reassurance. So again, they may be struggling to add barrels at this time, even though potentially they see that demand being strong enough in a couple of months' time to justify increasing production.
The Henry, we saw over the last few days the continuation of this standoff between China and the US and Europe. Now, Europe and the US imposed some sanctions earlier in the week. The Chinese hit back yesterday. Where do you see this going and its consequences for the markets?
Yeah, I think this is a very important point you bring up, Sean. And I think this is one of the top geopolitical problems really facing the world at this stage. And when I was invited by the House of Lords to speak on a Asian geopolitical roundtable that Lord Howell chaired about the South China Sea, I think there are very, very dangerous situations stands off between different nations, between US, China, and including other Asian countries and other countries as well. I think this is I think there are some issues where people need to, which have entrenched positions, but it's also very encouraging to hear that both sides agree there are issues that they can start to work on, such as climate change and other areas. And I think on climate change, there are many, many areas that the US and China can cooperate on. I think one area which is really quite significant is in biofuel. I think before the standoff that was the sanctions that was announced by President Trump a few years ago, one of the things that China was going to buy from the US was a huge amount of biofuel from corn. And I was interviewed when they invited me to speak in the Oil and Money Summit in London, together with the CEO of Shell and BP and others. And that was one of the multi-million deals that just went down the drain because President Trump at that time slept on the sanction. And this is a huge area where both countries can work on, because China.
Do you think the West? Do you think the West, the US, the new administration, or Europe is underestimating the new kind of robust determination of the Chinese government to sit at the top table, and that they will not tolerate this kind of sort of instruction, if you like, from the West? Is that era over? Are we underestimating that, do you think, on the geopolitical level?
I think it's a very important point you are bringing out, and this was certainly something we discussed together at the geopolitical roundtable that Lord Howell chaired together with other global leaders and experts. I think certainly the general agreement is that China is now fast becoming the second largest economic power of the world and looking towards overtaking the US in 2030 or even sooner. So I think it is right that China wants an equal place and to be treated as an equal partner at the international roundtable. And you know, in my history of negotiations in China over 20 years, and having negotiated many multi-billion contracts, they always stress, the Chinese chief negotiator always stressed to me that they want to work on a win-win basis, equal basis. And this is, we have to conduct all our negotiation on an equitable win-win basis. I think this is something that the chief negotiators or the chief diplomats from the US, EU should really bear in mind. And I have written about it in my book on negotiations after completing some of these negotiations in China.
Kevin, I'd like to come back to the contango point and just pick up on a comment in the chat room. What does the panel make of the weakness of the distillates market globally? Contango in both Asia and EU cracks below 450. Your thoughts on the outlook for contango to bed back in again?
Yeah, I was actually looking at this yesterday, and I thought that gas oil cracks and gas oil structure looked a bit toppy. I mean, east-west gas oil, so Singapore versus Northwest Europe, effectively, has been positive and very, very slightly negative in recent weeks, which has basically meant the arbitrage to Europe hasn't worked. As a result, what we've seen is a significant buildup of gas oil staying east and going into tank and going into floating storage. And we've seen the structure defying that situation. So we've got oversupply, but the market was still either flat or ever so slightly backwardated. And I think it was a matter of time until we saw the weakness really reflected in the market. As we know, the demand for pretty much anything apart from gasoline at the moment is very weak, right? And the middle distillate complex, jet and gas oil, are also relatively weak. So what we've seen is, you know, the market is finally reflecting that oversupply and that weakness in this region in particular, and in Europe as well, and therefore we've gone into a contango structure. So we've got a little bit more of an incentive to store. I personally think because of the ongoing production, Chinese refineries are still running pretty hard, and regional refineries also running pretty hard because of gasoline demand, because of naphtha demand, and that's going to create an ongoing surplus, if you like, of distillate, and therefore I can see the contango getting steeper, getting deeper, and you know we'll see this sort of virtuous circle of increased weakness and increased floating storage, and therefore you know there's going to be an overhang in the market. There's going to be an oversupply in the market for the foreseeable future. So I think this contango has been coming, and I think it can last.
Ole, back to the OPEC point. We had the UAE energy minister overnight commenting that OPEC won't put more than the market needs, but the reality seems to be that we're seeing others do that, right? We've got Iran moving now, according to many secondary sources, about 1 million barrels of exports a day into China. We've got Libya, of course, over the last 3 or 4 months, back well above 1.2, 1.3. And now we have the question of shale. And it seems the shale producers are very aggressively refinancing and hedging forward, locking in some really attractive production relative value there. I'm wondering, how much is this market moving away from the tight grip that OPEC Plus has held?
Well, in a falling market, they tend to loosen their grip, because then it's okay that some doesn't comply with their quota as long as the price goes up. Then they're kind of they're being allowed to quietly. But now they have a meeting where we suddenly see the market back down close to $60. That could potentially mean that there will be increased focus on compliance once again, just in order to try to rein in some of those barrels that the market clearly doesn't want at this stage. The question is whether that's going to be if they're going to have any impact on Iraq's willingness to cut back. Iran, obviously, they don't really have much sway over. Libya, they are producing as at will, once what the situation on the ground basically allows them to. So it's a tricky one. So I think
is there an argument, you think, for OPEC to actually OPEC Plus to have to actually increase supply despite the falling price, because of these extra barrels that are coming into the market? The longer they delay it, the more they could risk losing market share for a longer term.
I don't think so, because at this point in time, they also now with price in the US back below 60 again, that's also obviously having an impact on them. So there was no doubt that when we got up to around $70 in Brent, 65 plus in WTI, we saw $20 billion worth of high risk debt being issued to oil and energy companies over the past so far this year. That's a record or the highest level since 1996. So clearly they're not down and out. They at those levels they were either refinancing or getting ready to add some additional barrels into the market. So I think at this point there probably will be more focus on compliance. And we have to remember as well, contango is a combination of several things. Obviously, we would like to see contango backwardation as a sign of the underlying demand in the market, but we also have to accept the fact that the speculators, they are operating at the front of the curve. So when the demand is strong from a speculative perspective, backwardation comes in. When prices goes up, we see the swap short start to increase because banks are selling on behalf of producers further out the curve, and that's further creating a sense of a market in backwardation. Now suddenly we're seeing the unraveling of that, and that's primarily why we're seeing the market back in contango, because overnight the demand outlook hasn't shifted dramatically over the last 2 weeks, but the investor interest has.
Let's move to the room and give everybody the chance to vote on the survey question and this topic of outlook for contango. Both benchmarks touched their lowest level since early February yesterday, falling 15% from the recent highs. The front run spread for both moved into contango. And the question is, do you expect this flip in the market structure to sink in, to embed, and to sustain? Yes or no? Do you expect this flip in the market structure to sustain? Yes or no? And we look to move forward. Henry, we have the situation in Asia, the demand recovery. We've seen Europe in particular now suffer yet again further lockdowns. The language from the German chancellor yesterday, quite profound in its sort of warning of a new, as she described it, as a kind of a new pandemic rather than a continuation of the year-old pandemic. Can Asia move forward with Europe and with the West still suffering? Can China reach its 6-7% growth under these circumstances?
Well, I think this is a very important question, Sean, that a lot of leaders and economists are looking all over the world to see if this could. I think different country will do differently from what I observe. It depends very much on how strong the lockdown and the barriers, so to speak, that countries have put around themselves. For example, for China, I think that is a very strong entry requirement. For example, if people now need to go to China, they need to show sign of vaccination, or they need to have go into long isolation. If they want to come to Hong Kong, for example, this was just being discussed on the news. Yeah, the chief executives said everyone who comes to Hong Kong at this moment has to go into 21-day quarantine, but they are looking at that to see if they can relax that. But at the same time, there are lots of experts saying that there's various kinds of variants, particularly that are like in Latin America, Brazil, South America, South Africa, which are very, very dangerous. And there's another one in France, which is supposed to be very, very dangerous. So I think really every country has to go into. So at this moment in time, China has announced its target in the National People Congress of next year's growth, reaching about 6%. And a lot of this they can do with the internal market. A lot of work is being done on boosting internal consumptions. When I was based in Beijing, in our headquarters there, I know certainly the amount of work that has went in over the last 20 years to boost internal demand. They shifted the model from China as an exporting manufacturing economy to an internal consumption economy. And they've done that very well. And they are now very, very careful in preserving what they have gained and further boost that. And the international issues that are now, or the standoff as you brought about, has actually boosted more patriotic buying in Beijing,
Right.
buying Chinese goods and things like this. So this is actually something that is very important that different countries have to take into consideration as they plan ahead their international trade policies as well as their foreign policies.
Kevin, looking at the contango bedding in, as you sort of suggested, where is the capacity at the moment for storage in Asia to take advantage of the new contango, if it indeed does become sufficient to look to store for the forward curve?
Well, it depends on whether you're talking about crude or products. But I would say that if we look at crude in particular, Chinese inventories have actually dropped over the last few months. We saw a peak. I mean, we saw an interesting pattern last year. China rose from 800 million barrels in storage to about 960 million barrels in storage by about September. It's currently sitting at about 935 million barrels according to our own data. But we know that the Chinese capacity has actually grown over the last year. They've been building storage there. So there is the capacity to take on, there is the ability to take on additional storage in China. But it's swinging across onto the product side of things, and especially looking at floating storage, we've started to see that building again. Now the contango is going to incentivize that, and as you'd expect, the focal point of Asia for floating storage is all around the coast of Singapore and southern Malaysia. And over recent weeks, we've seen, sort of relatively stable levels of gas, oil, and jet. 3.5-ish million barrels, which is not small, by the way, on a historical basis. But we're starting to see an increase in naphtha storage, and we're starting to see an increase also in gasoline storage. And all of this sort of is reflected in the structure, and the structure is effectively facilitating that. And I think that's going to continue. And as you'd expect with the contango structure, the money's there. It covers the cost of carry, it covers the cost of the vessel, it covers the cost of insurance, it covers the cost of everything else. So I think we're going to see that continue for a little while yet.
Let's bring up again the survey result to give Ole the last word. Do you expect this flip in the market to bed in? 69% yes, Ole. The contango market is there. Your thoughts on that and how that might impact the demand recovery that we're expecting? You mentioned it yourself earlier, that if we're to hit the numbers that the IEA are pointing, 5.5 million barrels of demand recovery in 2021, the second half of the year will have to be pretty robust.
It has to, and it probably will be, because the vaccine rollout will obviously continue. But if we're going to miss the important summer months, then we may struggle to get to that point. But I think, even though we've grown accustomed to a demand situation that's been tricky and has been slow in recovering now for the past 6 to 9 months, and having seen prices back to 60, I assume, or I suspect, we will get some kind of, first of all, verbal intervention if we start to break below 60 in Brent, and so I think we can most certainly not rule out OPEC Plus to step in and do something again on the supply side in order to keep the market balanced and potentially just continue to withdraw some barrels. So I see the contango situation in crude oil as short-lived. As it's a reflection of both the demand side, but also the speculative side, which has been forced to cut production or cut their lengths back. So I expect some kind of reaction from OPEC Plus in order to stabilize the price and thereby reducing the contango. And right now, it's only the front end. We are still seeing backwardation further out the curve.
I mean, the one thing we would say, Ole, is that the economies, even though Europe is experienced further lockdowns, they have got used to coexisting with COVID, and economic activity does move ahead.
Absolutely, and I think we'll see that around the world. Some worries right now, I would say, with probably the biggest consumers, which are some place like India, where there are renewed signs of lockdowns or worries about spreading once again. So again, it's just such a difficult beast to knock down, and we've been optimistic on several occasions, but I think we just have to be patient.
And I suppose also the reality of this market, as we've said here a number of times, there's still a massive idle supply, 8+ million barrels of idle supply sitting on the sidelines. That's going to weigh on any market, no matter how fragile the backdrop is. And this backdrop, as we know, is quite fragile. I'd like to just wrap up by acknowledging the passing of the Dubai deputy ruler, Sheikh Hamdan, the UAE finance minister, was just announced here in the last hour that he has passed away. And so condolences to the local ruling royal family on their loss today, just to make that acknowledgement. Thank you, everybody. Henry from Hong Kong, really appreciate you joining us today for the first time. Hopefully you'll be back. Ole as well, thank you so much for coming in from Denmark, and Kevin from Singapore. We have our halftime talk interview this week with the CEO, Chief Commercial Officer of RWE Supply and Trading. His views on LNG, well worth listening to. As we know, out in Asia, they can't get enough of the stuff. All the best. Thank you, and we'll catch you up later in the week. Take care.
Take care.